So the topic we have for today is the pass-through entity tax. So we're dealing with a tax at the state level that entities that are considered a pass-through entity would pay, and what the benefits of this would be for you. Let's see here. Let's get my, I want to share the screen here, but my problem is that
You should be able to.
let's see here. More breakout rooms in the chat. So where's the sharing? I want to share my screen.
It should be at usually in the bottom in the middle. It says share screen.
Yeah, here we go. So let's share a specific thing.
There you go. It's starting.
Here we go. Now I can see everybody and I can show this. So yeah, like I said, we're going to talk about the pass-through entity tax. As accountants, we like to use acronyms. So we call it the PTET or PTE tax. And this is going to piggyback off of what we discussed in the prior sessions. Remember the first session, we talked about the different business entities that we can operate as, being a sole proprietorship, other flow-through type of entities, as well as a C corporation. And those flow-through entities would be your S corporations and partnerships and LLCs. And then after that, we talked about qualified business income deductions, which you'd be able to take advantage of with each of these business operations. And we also discussed, depending on the type of entity that you were, you could get a better benefit. And now in this time, we're going to talk about pass-through entity tax and the different entities that are available to take advantage of this situation. And all of this builds off of what we discussed right from the beginning with the entity choice selection. So let's move forward. So you guys probably recall several years ago, I'm sure you wish that you did not have the $10,000 SALT limitation on your itemized deductions that came through in 2017 with the Tax and Jobs Creation Act that was passed in December of 2017, effective beginning 2018. There was a limitation put on itemized deductions for the tax deduction that you could take. And everyone spoke about this. They talked about it, and it was called the SALT deduction, state and local tax deduction. And it was highly discussed in those high tax states on the West Coast, California, Oregon, in the Northwest, and then in the Northeast, New York, and Connecticut, and many states in between, but it did not affect several states in the middle of America as much as it did on the ends. And what it did was it limited, like I said, your deduction for your itemized deductions. It limited the tax deduction to $10,000. Mostly those are your income taxes that you're paying at the state level and your property tax deductions or property taxes that you pay for your real estate property or personal property. So when that came out, that happened, tax strategists were starting off immediately. How can we get around this? Because this is cutting a huge amount of deductions for a lot of individuals across the US. And there were a couple of very creative, I'd say, creative ideas that were out there. And the IRS got wind of this and said, no, don't even try to do that. We're going to come after you. You know, one interesting one I'll say is that people were coming up with ideas where a locality, a town or a county would create a charitable organization, and people could make contributions to this charitable organization, and the town or the county would give a tax credit to the individuals for whatever amount that they paid into the town or the county's charity that they had created, credit towards their property taxes. And the IRS understood this was just a blatant disregard to the rules that they had just created and put into law, and they're not going to allow that to happen. So a couple of strategists came up with another plan, and that strategy was the pass-through entity tax. And the IRS blessed that with a couple of parameters, a couple of requirements. They have safe harbor rules that they had put into place. And as long as the states followed these safe harbor rules, then the IRS is not going to do anything about it. Connecticut was the first state to actually adopt what's called the SALT workaround, or the PTET. And now we've got 30 states plus the District of Columbia and New York City offering some sort of pass-through entity tax. So what is this pass-through entity tax? So first, let's talk about a pass-through entity. What is that? That is an entity that passes all of its revenue, deductions, gains, losses, all of the activity within the operation. They pass it on to the owners. So the business does not pay any federal tax. So if the business is a disregarded entity or a sole proprietor, then all of that activity is going to be reported on the individual's tax return, a Schedule C. And that individual is going to pay tax on that activity reported on their Schedule C. If the business is a separate entity, a legal separate entity, and it's required to file its own tax return, then it would report the activity to the IRS on the proper form, and then pass on the income to the owners via a Schedule K1. And then the owners would report that activity and pay tax at their income tax level. So that's what a pass-through entity or a flow-through entity is. It's an entity that will calculate all of the activity, won't pay any tax. It will either report the tax itself to the IRS and pass that on to the individuals to pay the tax on that income. So the pass-through entity tax is a tax that allows the entity to pay and deduct the state income taxes at the entity level. So the taxes paid, that will be considered a normal deduction for the company, and it would be able to reduce the income of the company at the federal level, and thus reduce the federal income tax that's due, and essentially reduce the federal income that's reported by the taxpayer. So if the income is lower because of this pass-through entity tax, then we're effectively getting around the SALT limitation at the federal level. We're taking it at the business before it gets to the individual's tax return. So in all of these states, the states work around very greatly, but the overall objective is the same. And that essentially is that the states will impose a tax at the company level, and then the pass-through entities owners are going to receive a state tax credit or deduction that they would be able to take on their personal state tax return. So the pass-through entity tax is paid by the company, reduces the owner's federal taxable income that's reported, and then the tax obligation by the owner or individual, their state tax obligation is reduced by the credit of the tax that's paid by the company. So you're not double paying tax. We're just shifting the tax that's being paid from the individuals to the company so that we get a benefit as a deduction.
Hi, Joe. I just have one question here from Molly.
Yes.
She is an S Corp, wants to know, does she have to pay self-employment tax? It seems that S Corps have more write-offs as well. So I don't know if this would be a good time to answer that.
Sure. So the self-employment tax is a tax that is imposed on someone who is considered self-employed. That would show up if you are a sole proprietor or single member LLC that is disregarded and reported on your personal tax return under Schedule C. And also, if you are a partnership, all of the income activity flowing from a partnership that you are reporting on your individual return is subject to self-employment tax. An S corporation, the income that's coming from the S corporation is not subject to self-employment tax. So that is a benefit over being a partnership. But as an S corporation and being an owner of an S corporation, you do need to pay yourself a reasonable salary. And as a reason, as a W-2 earner of the S corporation, that is where you would actually pay payroll taxes. And so self-employment tax is synonymous with payroll tax. And so that's the only piece that you would be paying, self-employment or payroll taxes, whatever you have as a reasonable salary that's coming through would be reported on a W-2, as opposed to all of the income that would be reported flowing from sole proprietorship. So you do have some piece, but not all of your income is going to be subject to self-employment. And in fact, there's nothing for an S corporation to be subject to self-employment tax. What's the other piece of the question?
I think you've already answered it, but I think it was more so that S Corps have more write-offs.
There are better opportunities to write off additional expenses as opposed to other forms of businesses, which we discussed in our first seminar. And again, those previous seminars, They may be recorded,
Yeah,
but I don't think the first one was actually recorded, but the PowerPoint presentation, which provides some of the information and hopefully gives you enough information to ask questions to your advisor, where you could get the answers that you're looking for.
yep, all of that is hosted on our community platform. Thank you. So we can, I think, no other questions right now, so we can continue with the pass-through entity tax.
All right, so here we have, the big question is, who does the PTE tax apply? And here we go. You guys should remember this slide from our very first seminar, where we discussed our entity choices. And also the second one, we also talked about with QBID, we also had the same listing. So the following businesses are considered a flow-through business: your sole proprietorship, which includes your single member LLCs that's disregarded, owned by an individual. Both of those will be reported on your Schedule C within your 1040. And then you have your S corporation, your general partnership, limited partnership, the LLCs, that's a multi-member LLC. That would, by default, would be taxed as a partnership. And then your limited liability partnership, or LLP. So all of those are flow-through businesses. That means that they don't pay tax on any activity that they either report or have going on within their operations. But not all of them are pass-through entities for this purpose, for the purpose of the pass-through entity tax. So they're all flow-through businesses, but not all of them are flow-through entities for this purpose. So who wants to guess which one's not going to be considered a pass-through entity for the pass-through entity tax? So I'll go 5 seconds. You guys can just say it to your head. You can shout it out. You can hold up a finger or which one you think is not going to be. Yeah, it's the sole proprietorship. So every time we've had these discussions, we found out that the sole proprietorship or the single member LLC that's being reported on the individual's 1040 within Schedule C, that type of reporting has been not the most optimal reporting for taxes. And again, each time we went through these different seminars, we've shown where we should be going. That's going to be an improvement. And again, this seminar is showing that a sole proprietorship, if you're still reporting your activity on a Schedule C within your 1040 tax return, you may want to take a look to see if there's a better way to report your activity. Take advantage of some of these new things that are about. So let's go with a quick calculation to show the benefits of this. So we have a real estate agent. They're earning $525,900. The one on the left, should be both of our lefts, is there's no pass-through entity tax. And then the one on the right, New York pass-through entity tax, flat rate, 6.85%. So the federal taxable income on the left side with no PTE is 500,000, and the federal taxable income on the right side with the New York PTE is 463,976. So if you take the 525, multiply it by the 900, or 525,900, multiply it by the 606.85%, you get $36,024. And so that's what reduces our federal taxable income from 500,000 down to $463,976. So for federal taxes, married filing jointly, your taxes would be $124,089 with no PTE. Your tax would be $111,480 if you did elect to be in the New York PTE. And then at the New York state level, your tax would be $33,830 at the individual to the left, and then to the right with the New York PTE. The business tax paid $36,024 with its PTE filing. And then the individual reported all of the income from the business as well. It has income tax calculated $33,830. But the business passed on to the individual a tax credit for the taxes that it had paid on its PTE. So it gets a tax credit of $36,024. So that nets out to $33,830 is the net New York tax that's paid. So your total taxes would be $157,919 for no PTE, and then $145,310 if you did participate in the PTE. So we end up with tax savings of $12,609. And that's just from paying at the entity level versus no payment at all. And there are two pieces of information that I want to point out. One being, take a look at your state to find out what the benefit is going to be and how it operates, because each state is different. And Stuart, unfortunately, you're in Dallas-Fort Worth, Texas. You do not have an income state tax in Texas. So this, unfortunately, is not a great benefit for you. Same thing happens in Florida, but you have a lot of other great things going on down in Texas that make up for this. But in other states, I completely lost my train of thought, but the second thing that I want you to look at, number one, find out what the exact rules are in your state. And then number two, if you find out that this is a benefit for you, then you want to make sure that you do a projection. You do a calculation before the end of the year so that you make this estimated tax payment to the state before the end of the year. So it will then be a deduction for 2022. And you'll be able to take this credit and take this benefit with you when you file your 2022 tax returns. If you wait to make the payment with a return that would be filed in 2023, then whatever you do pay in 2023 is not going to be a deduction for you for 2022. You would have to wait till you file 2023's tax returns to get the benefit of the state tax payments.
We have a question which has to do more with vehicles than the pass-through entity tax, but could you answer the question about section 179 for vehicles and what changes that will bring after this year? This is from Dimitri in Florida, so I don't know if there'll be something specific state-wise.
Yes, when you talk about section 179 for vehicles and what changes that will bring after this year. So, yeah, for this, after this year, really, we got the depreciation, bonus depreciation that's going to change. It's been 100% for the past several years. Starting next year, it's going to go to 80%, and then it will go down 20% each year after that. With vehicles, you would be able to take bonus depreciation on those vehicles if the vehicle weighed more than 6,000 pounds. And 179 for these vehicles, my understanding is that you would be able to have a benefit by taking 179 for the vehicles instead of the bonus depreciation of the vehicles. There are pros and cons with the differences between section 179 expense and depreciation and the bonus depreciation. So bonus depreciation, if it's 100% depreciation, does not, it's not affected by negative business income. So section 179, you're able to deduct or expense 100% of the cost of those items up to certain limitations. But one of the limitations is that you have to have positive business income. And so that's where you'd want to take a look at your situation. If you have positive business income starting next year, with bonus depreciation being limited to 80%, you would be better off making a section 179 expense deduction and deducting that 100%. But if you don't, if you have a business loss that you are reporting, then you would be better off taking a deduction for bonus depreciation, even though it would be 80%, and then depreciating the vehicle going forward instead of hanging up or kind of limiting the 179 deduction that you have. So yeah, if you want to buy an SUV, definitely talk to your tax advisor, have a projection, go ready and find out whether you're going to be a positive income, and then that'll help you decide whether you want to buy it this year or whether you want to buy it next year.
Thank you, Joe. So Dimitri, I hope that helps answer your question. We are at time right now. What about recapture, say for next year's sale?
Yeah, so there is depreciation recapture on those items, and you'd have to look at that situation. Basically, what the recapture does is whatever depreciation you have taken, it's going to convert the gain from a capital gain to an ordinary gain. And so your deduction was ordinary deduction, reduced your ordinary income. And so what they want to do is recapture that income. They want to change the character from a capital gain to ordinary income so it matches. So yeah, that would be something you'd want to take a look at. But I don't know if you want to keep the vehicle for less than a year and sell it. That's not optimal.
Great. Thank you. Dimitri appreciates it. Thank you, Joe, for joining us. We will have, of course, one more session with Joseph Wilson. Actually, it's going to be after Thanksgiving. And we are slated to have Joseph join us on November 30th. So last round for taxes before the end of the year. You can get some more questions in. Joe will have some more material to present. And hopefully you guys will be able to go to your advisors that you work with and ask either some questions that you maybe hadn't thought of and or look at something a little differently that you maybe didn't think of. So we're just here to try to provide information. Everything is subject to your state. So please double check what laws and rules are specific to your state and work with your advisor accordingly. So thank you guys. We will see you next week. Happy Thanksgiving to everybody here. Thank you, Joe. Happy Thanksgiving to you too.
Happy Thanksgiving.
Take care, everybody.